Hey everyone, welcome and thanks for joining us here today. I'm Jerry O'Shea, Head of Global Market Insights at Hashdex Asset Management, and with me is Samir Karbaj, who's our Chief Investment Officer. For those of you that might not be familiar with Hashdex, we're a crypto asset manager. We've got investment products in the US, throughout Europe, as well in Latin America. And our mission is to connect investors to the crypto economy through high quality education and simple and secure exchange traded funds and other investment products that allow for regulated access to the crypto ecosystem. And as we get started here, Samir will give a little bit more background on Hashdex momentarily. But today, as part of our overall mission to educate, we're here to talk about some recent developments that are giving US investors broader access to the digital asset ecosystem. And before we get going here, there's kind of two very quick administrative notes. First, we will be taking questions throughout, and we'll save some time toward the end to hopefully address all the questions that are submitted. So please feel free to submit those questions as the conversation evolves. And second, I do need to read a very quick disclaimer before we get going, but this webcast is for informational purposes only, and nothing should be considered the official opinion of Hashdex. This presentation is not an offer to buy or sell, nor is it a solicitation of an offer to buy or sell. Certain information contained herein constitutes forward-looking statements. Due to various risks and uncertainties, actual events or results and the performance of the products may be substantially different from those reflected or contemplated in such forward-looking statements. As a result, investors should not rely on such forward-looking statements when making their investment decisions. For any product-specific information, please refer to the appropriate prospectus. So let's get started. Samir, thanks for joining here today. And I think it's arguably been the busiest, most impactful year for digital assets this year. We're now in the fourth quarter, and the first three quarters were incredibly eventful. It looks like the fourth quarter is shaping up to be the same. But before we kind of get into some of the more specific questions, I was hoping you could start with some background on Hashdex, and then kind of discuss what's changed recently, particularly in the US, with regards to how this asset class is viewed by regulators as well as investors.
Sure. So, thanks, Jerry, and thanks everyone for joining us. It's definitely been a very busy year for crypto, not just in terms of price action, but if you look at real institutional progress and regulatory clarity, it's been a milestone year for crypto adoption. At Hashdex, our mission is to make crypto investing very simple, efficient, and aligned with the standards that the advisors expect when they look at investment opportunities, and especially what they already use in traditional markets. And that's what motivated us to launch the NCIQ. So it is the first multi-asset crypto ETF in the US. It's built around the same index-based principles that have revolutionized crypto equities investment throughout those last few decades. When we launched the NCIQ in February, the goal was simple: to give like a broad evolutive exposure to crypto as an asset class. So not just Bitcoin, one instrument that would allow advisors to get a broad exposure to the space, and one that's going to evolve over time as the market evolves, as the regulation evolves, most importantly. And at the time, Bitcoin and Ether were the only assets that would meet both the index and the regulatory listing rules. So the requirements that we need to fulfill in order to have a listed product in the United States. So since then, a lot of things have happened. And we've been seeing with this US administration a strong push towards regulatory clarity, towards bringing innovation in crypto back to the US. And one of that's very important fronts is the SEC, and how the SEC is approaching listed crypto products. So if we look throughout other countries, a lot of countries in Europe, Switzerland, Germany, France, and Brazil, Canada, there's some regulatory clarity around crypto ETPs for a long time. That has allowed investors to benefit from this asset class and to start allocating this into traditional portfolios. We didn't have that clarity in the US up until last year. when the Bitcoin ETFs were introduced, but still the market was pretty much restricted to only Bitcoin and Ether. Now, recently, the SEC has approved what we call generic listing standards for commodity-based ETPs, specifically for crypto ETFs as well. And those generic listing standards, they basically outline that as long as the portfolio, the crypto assets in a specific ETP satisfy a certain criteria, they can bring to market without an explicit approval from the SEC, which sometimes takes more than 6 months to get. So this has allowed us to expand the number of assets that we include in a product like the NCIQ, and this will allow a new wave of crypto ETPs to be introduced in the market. So in the past weeks or so, we have expanded the product beyond just Bitcoin and Ether to include XRP, Solana, Cardano, Stellar. And this is reflecting both the market maturity, so how this market is evolving, but also the regulatory clarity around the space, which it's evolving in a very strong pace. So this index, and for the NCIQ, which is the product that tracks this index, is a listed product at the Nasdaq exchange. They're doing exactly what we designed it for, to evolve as the market evolves. And that's our goal with crypto index investing.
I know that you and I have been all over the US here in the last month or so, as well as a lot of other of our team members at different conferences with wealth managers, financial advisors. And I think, one of the things I've noticed at least is the level of questions that we're getting from advisors in particular now are much different than they were even a year ago with this, in particular, the regulatory clarity that we've seen. There's still challenges, and I think, we have a lot of kind of anecdotal evidence of that in conversations that we've had with these professional investors. But what do you see right now as the kind of major challenges for advisors that are thinking about entering into this space?
So with all the market developments and the regulatory developments we saw in this last year or so around crypto, especially in the United States, the general feeling that we're getting from our conversations with advisors is that the time has come for them to look at this as an asset class. So it's already too big to ignore. Crypto market capitalization is already a big part of the global capital market. We now have listed products available from multiple different asset managers, a lot of different ways to get exposure to the space. The client interest is there, so they're getting questions from their clients almost on a daily basis about crypto and how to position on this asset class. So they are in a moment, and that's our sensation based on all the conversations we're having on a daily basis. They are in exactly this moment in which they need to look at the solution. They need to find a solution for their clients, and they need to start having this type of conversation with their clients. And I would say right now, what we see is that advisors, we've been feeling them facing what we call a false choice. They have, they've been forced into either not having any allocation at all and miss this generational opportunity because it's too complex, because there's no clarity and all the things. It's too complicated for them. They have also the possibility of offering direct access to crypto for self-custody. And with that, they have all the operational, tax, and compliance burdens that come with managing crypto assets directly. And most recently, they had this option, this possibility of getting exposure to Bitcoin for the Bitcoin ETF. So a Bitcoin-only exposure, which concentrates the risk around one specific asset and ignores the diversification, the potential of diversification across this ecosystem and how big crypto is. Crypto is not just Bitcoin. And I like to compare this with back in the internet in the 90s, in which the only big application that people thought about the internet was the email. And now, 10, 20 years later, we still use email on a day-to-day basis, but it's by far not the application that created the most value from the internet. We believe the same thing is happening to crypto. And if advisors are faced with this false choice of having to select only Bitcoin because this is has the long history or been trading for a long time or now has a Bitcoin ETF, we think this is going to limit the opportunities that they present to their clients and limit the diversification aspect of it. So we designed the NCIQ to remove this false choice. So it gives clients, institutional clients, advisors, retail clients, a simple way to get exposure to crypto without having to manage wallets, with no tax headache, no single asset risks. So one Nasdaq listed ETF. So it's a simple way to get a broad exposure to the market. And we think with this, we can bring to the majority of the advisors the solution that they need. And this is how they approach any other asset class. When they start in allocation to any other asset class, they start with a simple, diversified index, a passive approach. And then you can build on top of this and evolve over time. But we believe that the core allocation starts with simple, diversified, and passive.
And advisors are obviously very familiar with index investing and retail investors as well. Do you think, or how does a crypto ETF, an index ETF, how can it provide the same sort of diversification benefits? I know you touched upon that in your previous answer here, but curious to know, as these types of advisors are looking at this space and thinking about diversification, familiar with index products, what are some other things that they should be thinking about with regard to this asset class specifically?
So advisors already understand the power of indexing, and then the power of passive. It brings diversification, brings transparency, rules-based exposure, cost-efficient access. The same logic that applies to crypto. So we can see that crypto is a new era of digital transformation. So I always like to compare this with the internet, this evolution on how crypto is bringing a new functionalities, new ways for us to interact online. And now we're finally in a moment in which the applications are starting to come. We haven't the Stablecoin Act, the Genius Act, giving the regulatory clarity here for stablecoin businesses, and we expect banks and big financial institutions to start offering this. So just like the internet connected data and people, blockchains are now connecting value and ownership, and will allow us to upgrade the financial system with more efficient rails. We've seen now, especially with this regulatory clarity, how adoption is growing across multiple different industries. So we have payments networks evolving, especially now with stable coins, tokenization. All the big banks, financial institutions are exploring different use case for tokenizations. We have security, Internet of Things, AI. So crypto is not a niche corner anymore. It's becoming a foundation technology for a lot of different industries, right? And if we look at adoption, we're just in the beginning. This slide here shows how early we are in crypto adoption. So we have roughly, close to 700 million people using crypto now. That's the same pace of adoption that we saw in the internet back in the 90s. So actually, this chart here compares how the crypto adoption is growing comparing to how the internet grew starting in 1992 throughout the 2000s. And you can see that we are on track to reach 1 billion users. And we are just like the internet was back in 2000s. So imagine if back in the 2000, you had the possibility of invest in this new internet technology, in a basket, in a crypto, in an index that would give a broad exposure to the internet. That's what we think, that's the phase we are in crypto. So we're very early. There's still very small number of use cases, but those are growing overnight. And we have all those big institutions and a lot of different startups, a lot of different companies experimenting with this technology, just like we saw back in the 90s and the early 2000s with the internet. So this is the moment that we are in, and this is the possibility that advisors have now in this new regulatory environment in the US. There's finally a product that gives a broad exposure to this space. And this slide here just reminds us how early we are and what the size of the opportunity is. So if you look at the crypto's total market capitalization now, it's close to $4 trillion. It's tiny compared to global equities, to real estate, and to other asset classes. So there's a lot of room to grow as this ecosystem expands, and especially as more institutional investors, professional investors start to bring this into the portfolio. So we're very early into this evolution, this technology, and that's the moment in which having a diversified exposure will help you, because it's very hard to pick the winners, especially when we are so early in the adoption. This is what crypto indexing brings when you're considering investing into this asset class. This brings this possibility of being an evolutive evolutive path to exposure to this asset class. You don't have to pick the winners, and most importantly, an index that's going to evolve as the market evolves. So as more cases become mature, as they qualify both on the listing rules and also on the index eligibility criteria, they can be included in the index over time.
I want to shift here to talk a little bit more about portfolios and how crypto can impact portfolios. So you've been at Hashdex since it was founded in 2018. At the time, Bitcoin wasn't even 10 years old, but since then we're going on 8 years here at Hashdex, and Bitcoin has obviously evolved some other crypto assets as well. What do we know, or what have we learned about the impact of this asset class on portfolios that you think advisors should know?
So, of course, the most common comment and question and comments we hear around is performance, right? So if you look at crypto's performance over the last 10 years, it's been outperforming most of the asset class on a consistent basis. But we think that the key question for advisors is not performance, it's the impact on the portfolio, right? So how that small allocation could change the dynamics of the portfolio. And the dynamics of this asset class, when we consider this higher volatility, this strong long-term potential, and most importantly, how uncorrelated it is to traditional asset classes, it makes it a very interesting diversified. And as we think about the 60-40 approach and how advisors are having to evolve on top of this to keep meeting the goals of their clients over time, especially as we've seen this generation living longer, and how this is changing portfolio impacts, how the bond market and all the geopolitical and macro environment is shifting the approach towards bonds. We've been seeing this movement of looking for more alternative investments, more uncorrelated returns that they can contribute to the portfolio. And crypto can be a very strong diversified in the portfolio, because it has shown historically a low correlation to the other asset class. So when you compare Bitcoin's or crypto's correlation here, we're using the Nasdaq Crypto Index as a benchmark. When you compare this to the Nasdaq 100, to the S&P 500, or to bonds, you can see that they have a lower structural correlation. Of course, there are periods in which correlations go up. This happens with all asset classes, and especially considering a risk asset class like crypto, it's normal to see higher correlations, especially when there's some macro dominance in the narrative. But overall, over the long term, it has shown very low correlation to other asset classes. And this makes it a very interesting diversified. So what we've seen is that a small allocation to crypto, and you can start with something like 1% or 5% allocation, can improve the risk-adjusted returns of the portfolio without changing too much the volatility on the portfolio. So in this study here, you can see a traditional 60-40 portfolio with no allocation to crypto, and then how that evolves as you move to 5% allocation or even 10% allocation. And you can see that the Sharpe ratio increases significantly from 0.3% to 0.5%. That's a very significant increase without changing significantly the volatility. And most importantly, without changing significantly the maximum drawdown, which is in the end what investors feel during a crisis. So this is because of the lower correlation and the diversification effect that crypto brings to the portfolio.
And I think it's interesting because this is definitely, not too dissimilar to other equities and even to an extent fixed income. But a lot of what's happened in crypto over the years is narrative driven, and maybe it happens even at a higher clip and faster pace than relative to other segments of the economy. And so, as we've gone through these kind of hype cycles, if you want to call them that, whether it was through, the ICO kind of boom, NFTs, decentralized finance, it's difficult for advisors to try to make sense of all these things, especially given how fast they move. And I know obviously one of the key benefits of the Nasdaq Crypto Index is the fact that it evolves over time. So I did want to kind of give you the opportunity to talk a little bit about that, the importance of that evolution and how it works to capture the value in this asset class over time.
Yeah, so this is a great point. Trying to pick winners in any asset class is very hard. In a nascent asset class like crypto is even harder. So if you try to navigate throughout all those narratives, it's going to be almost impossible to build a portfolio. And especially for advisors that are looking for a small allocation. If you're considering a 1 to 10% allocation, it's not worth your time trying to chase all those different narratives. So that's where the benefits of a rules-based index like the Nasdaq Crypto Index can capture these trends very objectively with no discretionary calls, no emotions, and not chasing trends, right? So as the market matures, the index rebalances, and they might add assets that become eligible and satisfy the criteria. So instead of chasing narratives, you can just rely on a passive and dynamic way to get exposure to the space. And this is not new, right? If we look at even at the other moments in the past, if you look at how innovation cycle happens, and we're showing how from in the last 40 years or so, how the narrative has evolved, right? So the top holdings of the S&P 500 back in the 90s are completely different from the top holdings now. And we have been seeing a shift in narrative from energy, from healthcare, financial services, to technology. And this is a clear shift. Of course, this is happening over decades. But the point is, with an exponential technology like crypto, all those narratives and all those shifts, they happen over months. And so last year, there wasn't a very strong discussion around stablecoins. Now, stablecoins is the big discussion, is the big thing that's going to change crypto adoption and it's going to take adoption further. So those narratives, they shift over time. This is normal to any other asset class. This is normal in equities. We've been seeing this throughout the last 100 years or so. And this is the same case for crypto. So that's why instead of trying to pick the winners or choose the narratives, and we've been seeing this especially with Bitcoin, and especially considering the geopolitical environment that we're in, the case for a non-sovereign store of value is stronger than ever. And people are starting to realize that there is a space for a digital store of value like Bitcoin. So this has been great for Bitcoin. But some investors are looking at this and thinking that the only interesting investment case for crypto is Bitcoin. And they're concentrating their bets on Bitcoin. And as the narrative shifts, they will have to chase the narrative. So once we start to see stablecoin adoption influencing smart contract platforms or decentralized finance being boosted by tokenization, this investor will have to chase those returns. So instead of having, this burden of trying to pick the winners, you can just go diversified with a broad index like the Nasdaq Crypto Index.
That's actually where I wanted to go next, to just maybe a little bit more detail. I think you might have a slide on the Nasdaq Crypto Index as well, but I think it would be helpful to go through a little bit more in depth in terms of how the index is set up, its methodology, and why we think it's a good approach for most investors.
Yeah, so this index was co-developed with Hashdex and Nasdaq back in 2020 to bring benchmark to crypto. So back then there wasn't any benchmark, any way to, to measure the performance of this asset class, and most importantly, to provide a passive exposure to the asset class that could evolve over time. And we we had this effort with Nasdaq to think about a methodology that could be very stringent, that could be replicable by institutional investors, but at the same time could evolve over time as the market evolves. And we came up with the Nasdaq Crypto Index methodology. And in order to be eligible, the asset must satisfy a set of eligibility rules. They're very stringent to make sure that institutional investors such as Hashdex are able to replicate this type of index. So we start with a universe of thousands of crypto assets, and then we apply those set of rules. The first rule is that the asset must have sufficient core custodian support. What is a core custodian? A core custodian is a service provider, a qualified custodian that can store this asset in a fiduciary manner. So they will store this on behalf of the client with all the safeguards that you expect from other regulated custodians in the market. So Nasdaq has a process of selecting those core custodians that are part of this methodology. And if the assets satisfy this, then it can be included in the methodology. So little more than 1,000 assets satisfy this first eligibility rules. And then you have the second eligibility rules, which the asset must have sufficient core exchange support. And core exchanges is the same thing. So Nasdaq would vet some of the crypto asset exchanges, and the asset must be tradable and liquid on those specific exchanges. And then you reduce this universe from thousands of assets to little less than 200 assets. The next criteria is that the asset must have sufficient liquidity, because we're supporting a liquid product, an ETF. So you also reduce this universe to little less than 30 assets that have sufficient liquidity to support a benchmark in an ETF. Then you have the fourth criteria, which is it needs to have sufficient support by ETF listing. So the listing exchange in the US case, it must comply with the generic listing rules. Internationally, they must comply with the different listing standards that we have throughout the European exchanges. And this reduces the universe also to 14 assets. And then they need to have sufficient free float market cap. And then you come with the list of eligible assets to 9 assets. So you basically, you get this universe of thousands of crypto assets, and you apply a systematic, basically institutional eligibility filter that will get you to the final universe. So there's no caps, no minimum number of assets or maximum number of assets. As long as the assets satisfy the eligibility criteria, it's included in the index. And this index has a quarterly reconstitution. So it means that every quarter, Nasdaq would run this methodology, would check which assets are eligible, and they might include or exclude assets based on satisfying those criteria. So over time, if the crypto market expands, and this is our core thesis, we believe the crypto market, we're in the very beginning, and this market is way bigger than just Bitcoin. So if this market evolves, more assets might become eligible. This index can have 10, 20, 50, hundreds of assets. There's no limit in the number of assets that this index can have. On the other side, if the market concentrates around 1 or 2 assets, around Bitcoin or Bitcoin and Ethereum, the number of assets are going to be reduced over time. So this is the interesting pure beta, pure passive approach of the Nasdaq Crypto Index. Once those assets are selected, they are weighted by market capitalization. So this means that whatever the market is pricing out the assets, this is going to be the weight in the index. And as some assets gain market representation, they can gain representation on the index and vice versa. So this provides pure passive beta exposure to the asset class.
So we have about 12 or 13 minutes left, and so I think I'll ask 1 or 2 more questions, and we have some questions coming in now, and I can ask those, try to get those in before we wrap up. But I wanted to, so the Nasdaq Crypto Index we mentioned early on, it was launched in Brazil. We had an ETF down in Brazil that grew to be the biggest crypto index ETF in the world. And I think it would be useful to maybe talk a bit more about some of the what we've seen as, with the US now opening up, what we've seen from other markets, particularly in Latin America and Europe, where we have ETPs. And both those regions were much quicker to their financial regulators were much quicker to embrace this as any other sort of financial instrument. And so, any kind of lessons learned or sort of what we've seen from our experience running these types of products in other regions that you think apply to the US?
So I think we saw two very interesting things happening, and this is both in Brazil, but also in Switzerland and Germany, as the regulators gave clarity for crypto ETPs to come to market. Uh, this has allowed the financial institutions to start being more comfortable with the space. So we saw this in Brazil, and now there is a regulatory framework around crypto assets, regulation for crypto exchanges, and a big push towards the tokenization of the economy and adoption of stablecoins. We've seen that in Switzerland for the last 10 years or so, in which most of the banks now offer direct access to crypto, and they see crypto as any other asset class. And we're seeing now this happening in the US. So last year, when the SEC approved the Bitcoin ETFs, this was a movement that started, making the financial institutions more comfortable with crypto overall, but especially now with this new administration and now this generic listing standards, this is giving clarity that crypto is no longer, something that's marginalized and at risk of being banned by the government, and this is attracting more players to the space. So this is the first one. The second one, and this is a very interesting insight that we've been seeing, and again across Europe and across LATAM, is that although single assets have a very strong appeal, especially for retail investors, the big demand for single asset ETPs is coming from self-directed retail investors and hedge funds. Hedge funds that want to deploy their own actively managed strategy using leveraging crypto assets. And self-directed retail investors are building their own crypto portfolios. They've been doing this on Coinbase and other crypto exchanges for a long time. Now they're doing this on their retirement account. But advisors and wealth managers, they've been looking for diversified solutions. So the adoption we've been seeing for smart beta, pure passive, factor investing in crypto has been mostly from financial advisors, wealth managers, and private banks. And this is the same trend we're seeing here in the US. So as we look at the US, the huge success we saw on the Bitcoin ETFs, this is mostly driven by self-directed retail investors and hedge funds deploying their actively managed strategies. And now that we have a crypto index ETF and that we have the generic listing rule that will give clarity for more products to come to market, we're starting to see an uptick of interest in financial advisors.
So I'm going to wrap my last question into a couple of the questions that we've gotten from the audience, and it's actually related to the general listing rule that you mentioned, with the SEC acting on that recently, kind of opening up crypto ETFs in the US. So this is kind of a two-part question, but one, where do you see the kind of the direction of regulation in the US leading to products and product development going forward? And the second part, we had a question about future constituents within the Nasdaq Crypto Index. Someone asked about Litecoin and whether or not that'll be in the index at some point. So maybe if you wouldn't mind just talking a bit about the impact of that generic listing rule, and then going forward, what we think it will look like from a product perspective in terms of having additional access to additional assets.
Okay, so when we look at the generic listing rule, it gives a very clear guidance for exchanges to consider new listings. And what we expect to see, and we're already seeing in the market, is that we're going to see hundreds of different crypto asset ETPs coming to market. Single asset ETPs of all the assets that are eligible, And over time, as more assets become eligible, we expect more single asset ETPs to come to market. We expect more different basket strategies, both like proprietary baskets, self-indexing, passive, more indices coming to market. So we expect the space to get very busy, a lot of different options. And this is great for investors. This is great for investors because it's going to give choice. And this is something that US investors didn't have for a long time. And we had this for a long time in other countries. We had this in Canada, we had this in Brazil, had this in Switzerland, Germany, France, and now this is finally coming to the US, to the largest capital market in the planet. So we believe this is great for investor protection, for crypto adoption, for choice, and for advisors adoption. So it's going to get very busy. Also, it's going to get more complicated, right? Up until now, basically the big option the investors had was go to a Bitcoin ETF and choose one of the Bitcoin ETFs. Now they'll have to pick and choose probably among thousands of crypto assets and crypto assets ETPs coming to market. This is going to get very hard to choose. And that's why we believe that the case for index investing is even stronger now. Now that there are options, that there is diversification, that is a whole range of products to choose from, we believe that the case for crypto index investing is going to be even stronger. To the second question around like specific assets being eligible, like I mentioned, this is a rules-based methodology. So as long as the assets satisfy those rules, it's going to be included in the index. Hashdex has no discretion whatsoever to select specific assets. So we can't pick and choose any asset that we like to be included in the index. We rely on this methodology because we believe that over time, the assets that satisfy this are going to be the long-lasting assets in this industry. So two things needs to happen basically for new assets to come and participate into this index, be eligible to this index. So two big bottlenecks. The first one is having sufficient market capitalization and liquidity. And the second big one is to comply with the generic listing rules, the SEC generic listing rules, those new rules that have been just approved. So as long as the assets satisfy all those eligibility criteria and the major bottlenecks are market capitalization, liquidity, and the generic listing rules, they're going to be included in the index. Every quarter, again, Nasdaq would run this methodology again. And if the asset is eligible, it's going to be included. So over time, you don't have to worry about any specific assets. The only question you need to ask yourself is whether crypto is here to stay and whether crypto is going to be better in the future. If your answer to those questions is yes, then you might want to have exposure, right? If you want to have exposure, the Nasdaq Crypto Index offers you a passive way to get an evolutive exposure to the space. So you don't have to pick winners and what about that specific asset or other assets, just buy and hold one ticker, and this is going to give you a broad market exposure over time.
We have a couple questions about shifting investor perspectives on this asset class. And so apologies, I'm gonna jam you with another two-part question here, but they're related. Okay. So volatility is something that we get a lot of questions about. If you look at surveys of advisors and other professional investors, it's often the top concern that they have with this asset class. But one of the questions mentioned how in the slide that we have on a NCIQ allocation that the Sharpe ratio improves with limited drawdowns over time. And the question is, are investors, are they responding to this, or is the volatility, kind of the dominant concern now, and they're not looking, at these other sort of risk-adjusted metrics, and so that's the first question, and then I guess the second and very related part of that is this changing their views, right? Is the improving risk-adjusted returns within this asset class, within portfolios, actually starting to shift the mindset of advisors and other investors?
Yeah, so this is a great question and a very frequent one because volatility scares people, right? And if you're used to looking at every single line on your portfolio, it's not like it's not comfortable to see a line on your portfolio going down 66%. And this is what we saw with the Nasdaq Crypto Index in 2022. But that's natural for any new asset class. That was this exactly same thing that happened with the internet back in the 90s and in the 2000s. Just look at Amazon's stock price over time. You see multiple drawdowns of 60, 70, 80% throughout 10, 20 years. That's normal for any new asset class. So that's why I like to tell investors that the difference between the medicine and the poison is the size of the dose. If you look for a 60% of allocation in crypto in your portfolio, this type of volatility is going to be very concerning because that's going to affect the overall portfolio in a very significant way. But if you look for a small allocation, and we're talking here again between 1 and 10%, that volatility can also be good for your portfolio because when you combine this level of volatility with the lower historical correlation, that gives a very good diversification impact to your portfolio. So again, looking this from a technical lens, is strictly positive, this volatility, because it gives this diversification to your portfolio. It gives another way to generate alpha on your portfolio over time. But if you look from an emotional standpoint, and that's where we believe that the work that the advisors do for their clients is critical, is managing their emotions and managing how they perceive the creation and the evolution of their wealth. This is the big thing. This is something that we cannot teach on schools. This is really, a conversation and making the client comfortable with going through the ups and downs in the market and understanding that this is a generational investment opportunity. So you cannot measure this in 3 months or 6 months time frame. You need to look at this from a 5 to 10 years time horizon. So I think that's where we believe that the role of the financial advisors is critical to manage the client's expectations, client's emotion, and most importantly, helping them with their behavioral biases. Because with such an asset class, when you see prices going up 100%, 130%, 200%, like our general emotion, our general biases will tell us that we need to put in all the eggs into that basket. So clients will want to increase their allocation and put more money into this, sell their house to buy crypto, and all those types of damaging behaviors that we've been seeing throughout those last few years. But then when this market is going down 66%, it's not comfortable as well. Clients will get desperate. They want to sell everything. So that's where we believe that the role of the financial advisor is critical to help them grow through this journey and calculate the right allocation to their portfolio, and most importantly, rebalance over time. So if you give discipline to this, then you can use volatility to your advantage. So for instance, if you choose to have a 5% allocation in a portfolio, in a year like 2023, in which this asset class goes up 130%, you're going to be rebalancing that portfolio. You're going to be selling the winners. So you're going to be selling that position and rebalancing throughout the other asset classes. And then in a year like 2022, when this goes down like 66%, you're going to be buying more. Again, rebalancing the portfolio. So when everyone is desperate out there, you having the discipline, you're buying. And when everyone is greedy out there, wanting to buy, you're selling. So this type of strategy, if you deploy it with discipline over time, then the chances of getting great results for your clients are very high. In fact, we have some studies that show that if you follow this strategy throughout, with disciplines, there's no window of 4 years in which you'll be worse off not having crypto in your portfolio. In smaller windows, like 6 months to 1 year, is like tossing a dice. It's anything can happen. It can be good, can be bad, can be very good, can be very bad. But over long term, especially over windows above 4 years, there's no example. There's no sample over the last 15 years in which the investors were worse off not having crypto.
That's great. Very helpful. And apologies because I think I asked you about 5 questions disguised as two there. So thanks for going into all that. And we're right at time here. And before we go, I did just want to mention that for those that might not be familiar with Hashdex, you can visit our website, hashdex.com. We've got a ton of education on all of this stuff, including two very new, very detailed reports on the case for index investing in crypto. So encourage you all to visit our site or using the QR code, which is here on the screen, or give us a follow on Twitter at Hashdex. And Samir, thanks as always for your insights. And thanks everyone for joining.
Thank you, Jerry. Thank you, everyone.